The Bank of Canada is set to meet again next week, and the question on everyone's mind is, are they going to cut rates again? And does it make sense to take that variable rate mortgage now or not? My name is Miles Noak of the Noak Mortgage Team, powered by Indy Mortgage, and today we're going to take a dive into the upcoming Bank of Canada meeting, what we think is going to happen with rates, and if it makes sense to take a variable rate mortgage or not. But before we get into that, do me that favor. If you find content like this interesting, hit that like and subscribe button so more people like you can see this video, and let's dive into it. Over the past few months, we've seen two back-to-back rate cuts from the Bank of Canada. This is all hinging on cooling inflation, a weakening economy, and unemployment increasing. With inflation sitting at 2.5% and unemployment at 6.4%, the likelihood of seeing a rate cut is pretty straightforward. That being said, some opinions are divided on whether they should be cutting rates further or not. Let's start for the cases of more rate cuts, as generally speaking, that's what a lot of people want to see. The general reason we should see more rate cuts from the Bank of Canada is definitely one, because inflation is cooling. They started boosting the rates to combat high inflation. That was the entire goal. Now that inflation is coming back down, it makes a lot of sense that they'd have some room to cut rates. The other thing we're seeing is a weakening economy based on those unemployment numbers. And I think a rate cut would be a welcome change for a lot of people and would definitely be helpful for the economy as it's starting to show some strain from these higher interest rates. On the flip side, there is the argument that if they cut rates too quickly, it could overheat inflation again by pushing up housing prices, therefore increasing the cost of a mortgage or the cost of rent. That being said, these arguments were made before the first two initial rate cuts, and generally speaking, we didn't see the real estate market explode. We saw a couple of new listings pop up, we saw, maybe a small uptick in price in certain locations, but at the same time, we haven't seen things go crazy, and we haven't seen the bidding wars that everyone was worried about. And I think the reason for that is there's not the same level of FOMO with this. The rates aren't historically low anymore. Back then you were getting a 5-year fix at like 2% or less. Now it's, around 4.5% or more. So the FOMO is definitely not there. There could also be a level of fear behind it as well. If we look back, the Bank of Canada said rates were going to stay low, inflation wasn't a problem, and to make those big purchases. And to be honest, some people really got bit by that. Some people followed that advice, and now their interest rates have climbed dramatically. So there could be a level of fear to match that lack of fear of missing out. So in all honesty, it's kind of like trying to sell something to someone who's not interested in the product you're selling at a higher price tag. It's just generally not going to work out. Now on to the questions around fixed versus variable. And no, this isn't a would you rather game, although sometimes it kind of feels that way. Now, let's talk about fixed rate mortgages. Right now, they're lower than the variables, and the variables will have to come down a bit further than just another quarter point to be on par with them. That being said, when you take a fixed rate mortgage, the big thing you want to look at is the penalty and the lender in which you're set up with. Fixed rate mortgages can charge you either a 3-month interest penalty or an interest rate differential. That means, let's say we're 3 years into a 5-year term and you want to refinance to get out to access lower rates, you're gonna have to pay that penalty. Now, when we talk about penalties, we really want to focus on the lender as well. And the reason for that is certain lenders charge certain types of penalties. So for example, if we look at TD Bank, RBC, CIBC, Scotiabank, Bank of Montreal, any of our big chartered banks, they're notorious for having the highest cost penalties in the industry. Whereas lenders like First National, CMLS Financial, RFA, Manulife, they have significantly lower penalties. So when shopping for this fixed rate mortgage in a declining rate environment, it's really crucial to make sure you look at the lender and how they're going to penalize you if you decide to get out of that mortgage early. Because nothing says I care like lower penalties. Now on to variable rates. There's two types of variable rate mortgages out there. There's a static payment variable and an adjustable rate mortgage. With the static payment variable, you guessed it, your payment stays static. That means as rates go up or down, your payment's going to stay the same. Now, with this product, in an increasing rate environment, as your payment stays the same, that can be beneficial as long as you don't hit what's called a trigger rate. The other thing you need to watch out for is if you don't hit the trigger rate, your amortization can actually extend, putting you in a position where instead of having, let's say, a 25-year amortization at renewal off of a 30-year one, you have something like 50, 60, 70. And to be honest with you, I have seen a mortgage statement with an 80-year amortization. And this runs the risk of payment shock. And the reason for that is when you come up for renewal, they're not going to give you an 80-year amortization. If you were a 30-year before, they're going to give you 25. And that's where you're going to see your payments increase. So is it a great option when rates are low and going up? Maybe not. But on the flip side, with rates going down, it could have some benefit to it. And the reason for that is as the rates go down, your payment stays the same. And that just puts you in a position where you're allocating more money towards your principal, therefore paying your mortgage off faster and decreasing that amortization. And as we all know, the faster you pay off your mortgage, the less interest you're going to pay on it. Now for the adjustable rate mortgage. With an adjustable rate mortgage, as rates go up and down, so does your payment. So if rates increase, your payment goes up. And a lot of people felt the pinch of that as the Bank of Canada went through this rate cycle, increasing the prime rate of Canada. When we talk about these adjustable rate mortgages, they really do have benefit in a declining rate or an increasing rate environment. Now, I know that sounds completely crazy, but stay with me for a second here because I got some good points on this. As the rates go up, so does your payment. This ensures that your amortization remains the same. If you took a 30-year amortization, you're paying your mortgage off in 30 years. So at renewal, you're going to have 25 years remaining, where with the static payment one, that can increase, causing payment shock. As rates go down, so does your payment, putting you in a position where your payment can decrease over time. That being said, is there the ability to keep your payment the same to pay your mortgage off faster? Absolutely. Most lenders have a prepayment privilege allowing you to increase your payments by 15 to 20%. And if you take advantage of that, well, you can have the benefits of a static payment variable while having the flexibility of that adjustable variable rate mortgage. Both of these mortgage options should be able to be locked into a fixed rate mortgage, depending on what's available and depending on their terms and conditions when it comes to locking in. Most of them, for example, if we're 2 years into a 5-year term, will let you lock into a 3-year term or longer. They won't let you go less, but they'll let you increase that for lower rates if that's your choice. This is also one of the only mortgages out there that can guarantee you that 3-month interest penalty, so you can avoid those costly IRD penalties. Now, that being said, with rates where they are, yes, the 3-month interest penalty is on par, if not higher than the penalties, but as rates come back down, you're going to notice that your penalty is going to decrease because it's based on that interest rate. Now, once again, lender becomes really important here. Some lenders are going to charge that penalty based on the prime rate of Canada. Some of them are going to base it on the contract rate in which you received. Now, the reason you want to make sure it's on the contract rate is because with most variables, you're prime less a discount. That means a lower penalty for you if you pay it out early. I'm not sure if you noticed by now, but I'm a big fan of lower penalties, like a huge fan, almost as huge as the penalties that chartered banks charge when you pay out their mortgages. Now for the big question. What do you take? Fixed or variable? And that really depends on you. My recommendation would be sit down and do a monthly and annual budget, looking at your expenses and your income coming into your account to ensure that you can handle payments if they were to increase. Now, I know we're in a declining rate environment and it's showing that rates are going down, but hey, if this recent rate cycle taught us anything, it's that anything could happen and you should hope for the best, but plan for the worst. So if you're sitting in a situation where you're strapped and you're spending as much as you possibly can on your mortgage, the variable might not be the best option for you. It might make sense to either take that static payment variable or to take a fixed rate mortgage, just in case rates do go up. Now, this is not me telling you to take a fixed or a variable. This is just some general rules and guidelines that I present to people when they're trying to pick one of these two options. And generally speaking, it really needs to be your decision. Are you comfortable taking the variable knowing that your payments could potentially go up? And when I talk about payments going up, if we look at this recent rate cycle, like I said, Bank of Canada said rates were going to stay low, inflation's not a problem, buy a house. Did rates stay low? Was inflation a problem? Yeah. I think sometimes they might be a little bit wrong. Sometimes hindsight's 20/20. Now, to sum up all this information that I just dumped on you, do we think the Bank of Canada is going to cut rates? Yes, I think they're going to cut by another quarter point on the September 4th meeting. Is that going to affect our fixed rates? Probably not, because our fixed rates are governed by the bond market, not the Bank of Canada. Believe it or not, the US job market has more to play on our fixed rates than our central bank does. Now for the second question. Should you take a variable rate mortgage? And honestly, that really depends on your personal economic situation. If I was to give an example of a really good time to take a static payment variable, it would be someone with a mortgage coming up for renewal with a smaller balance, where they're okay with paying that higher payment if their goal is to pay their mortgage off as fast as possible. If you're not looking to pay your mortgage off as fast as possible, then you really want to look at what's going to keep you comfortable. If you're going to lose sleep at night knowing that your payment could go up if all of a sudden something happens and prime goes up, don't take the variable. There's something to be said for quality of life and getting a good sleep at night. So at the end of the day, it really depends on you and it depends on what you're comfortable with. My recommendation, honestly, do a budget. If you're not doing a budget or don't have a tool that can help you with that and you want one for free, comment down below and I'll make sure to find a way to get it to you. We have an excellent one. It does all the math for you because who wants to do math? And we can make sure to send that to you and it is completely free. Now, I want to know what you think. Post your comments down below on whether you think the Bank of Canada is going to cut rates, whether you think a variable makes sense, whether you prefer fixed or variable. Let's see some of those predictions. Once again, my name is Miles Noack of the Noack Mortgage Team. If you got any value out of this video, please consider liking and subscribing to the channel. Thanks so much for tuning in, and we'll catch you next time.